All right, so quantitative finance, right? Nomenclature. Isn't finance supposed to be quantitative anyway? Is there such thing as non-quantitative finance? You're right. Quantitative finance sounds more like financial finance. But there is a reason why, okay? You used to value one single company. I mean, thinking about your valuation class or intermediate corporate finance class, the corporate finance or stock recommendation kind of things, right? And do some stock recommendations for one company only, right? One and only one. But here's the thing. Warren Buffett may say, right? He's a fundamental of value investors, right? He say, XYZ company, let's say, is undervalued now. Buy it because my DCF analysis tells so. But why did you pick up that stock and analyze in the first place? How did it caught your attention, right? Before you start your DCF. Did you look at all the stocks in the universe, in the market, with equal rigorosity? Right? Why did you pick up that stock in the first place? And then maybe because your boss told you to do so, honestly speaking, like a robot. Your boss says, you analyze this one. And then, no, come on. That's reality in fundamental analysis. And maybe because you were somehow anchored on that company. 꽂혔어요. I like 답정너. It's like I'm determined to analyze that company, Tesla. It's so sexy. I'm going to write buy recommendation, whatever. And as I do the DCF analysis, in this respect, in those respects, other respects, it's all great company. Like the CEO looks great, and then the business itself looks great, the electric car industry. Forgetting about all those shortfalls that, first of all, Elon Musk is a narcissist, like crazily narcissistic guy. Number two, the Tesla has awful problem of repairs and all this kind of. Those repair shops are not that much available compared to GM or Ford. Terrible. But you forget about that. You're already anchored on writing a good recommendation. Somehow. Why I got you anchored about it? Well, people talk about it, so that's why. That may be a reason. And then another question is, why only one stock? And then think about this situation. There are 2,200 plus stocks traded in the Korean market. Okay? 2,200 different companies traded in the Korean market. But only about 500 plus are really covered by serious professional equity analysts. Now, what about the remaining 1,700 plus stocks in the dark? Yeah? Did you all look at those things and then finally pick up that stock, XYZ? And US is even more. They have about 3,500 different stocks, and not all of them are covered by the analyst, right? Small stocks are not even, why small stocks are not covered? Because it's too risky and it's more like a lottery-like, lotto kind of extreme positive returns, but usually it's a penny stock. That means penny stock means its share price is $1 or something. It's rarely traded and it's too small or too distressed. So that those stocks are not held by mutual fund and pension funds for the sake of the fund holders, the policy holders' safety. Okay? So that's why the analysts are not covering those large number of stocks, right? But do you really want to forget about those, right? And there comes something called a new fashion, quantamental analysis. What is that? Well, quantamental analysis. Well, you first screen starting from the universe, the whole universe of the stocks, and then you narrow down. after screening something, after screening through those quantitative trading rules. Some stocks, we're going to learn about what stocks are, deemed as overvalued or undervalued, which stocks are supposed to be, longed versus shorted, so that, those groups of stocks, right? You get some idea about it and then narrow it down. Oh, these are the stocks that you have to buy it, long position. And it starts from 20 to 100, but it already narrows down to a certain group of them, and then gives you some more idea about where you should start your DCF analysis with, right? And then by doing those analysis, you can narrow it down further. And it's one of the part of the quantamental analysis, adopting these quantitative trading ideas. Now, quantitative finance, you buy and sell thousands of stocks simultaneously. Okay, over here, a value strategy or size strategy, right? You will buy and sell hundreds of different stocks simultaneously, and then you don't even care about, where there was accounting fraud or whatever, or is it, of course, all those guys, once they are identified as accounting fraud, you will take out, throw away, and not even think about investing in those stocks, right? But usually, whatever the CEO does, or the labor union strikes, or whatever in that individual companies, you don't care about it. In quantitative trading strategies, it's just a simple and easy sorting, 줄 세우기, right? All the way down. So that the name itself sounds sexy, but as it turns out, it's going to be boring to you a certain degree. It's like, sort with respect to what is a question, will be a question, okay? Sort with respect to size, sort with respect to momentum, right? Or past performance and that kind of stuff. Without even looking at their CEOs or CFOs, right? And then, can I do that as an individual investor? Not really for mom and pop or you and me, like, small investors. This is for the hedge funds and big funds, asset managers that can trade that many stocks cheaply. How many stocks do you have in your hand, right? In your portfolio? Not many, right? I have about less than 10 in my portfolio, right? It's difficult to remember what I have and when did I buy it at what price. But this is about buying and selling hundreds of thousands of stocks, okay? The trading cost for individuals, it will be huge. But for funds, it's not. Okay, there's a quantity discount, and so it's going to be much more advantageous just for fund managers, right? And subfields of finance, right? Let me give you some bird eye view about finance. Largely speaking, the field of finance, we split it into two. Okay, one is corporate finance, the other is asset pricing. Right, asset pricing, sometimes called investments, 투자론, right? And this is why you have intermediate corporate finance and intermediate investment in your curriculum of GBA, right? And corporate finance is more about capital budgeting or each different company's financial decisions, right? Investment decisions, NPV positive rule, right? And then M&As and investment cash flows, how to manage those things. And then capital structure is another area inside corporate finance. It's about bankruptcy prediction, syndicated loan, or bond issuance, or IPO, SEO, LBO, corporate restructuring, all these kind of things, and dividend payout policy once you do your yearly work and then get some profit out of it, and then it's time to distribute your income. So repurchases and stock splits, and etc., etc. And then corporate governance is another issue that combines these corporate finance small areas. each different ones, combining CEO incentives like pay and performance sensitivity, and CEO turnover, which means firing the CEOs. And then, isn't the hiring and firing the CEOs or CEO pay, right? Isn't it about human resource management? Partly yes, partly no. Why? Because those incentives, I'm going to talk about it later, but those incentives are option based, and then those options are in the domain of finance. So that's why human resource guys have a hard time understanding this, but finance guys tells much more about it. That's my area as well, and CSR or ESG, whichever way you want to call it, and that's that. And asset pricing or investment is what we are going to cover over here. Market efficiency and anomalies in short sales. Market efficiency is what I'm doing in my research. And then capital asset pricing model, that's something you learned, CAPM, before. The beta, if you remember. And Pharma French 3-factor model, 4-factor model, and then momentum, right? And then derivatives, option pricing, and financial engineering. Market microstructure is also there, high frequency trading, and bid-ask spread, and all these kind of things. They cover it in investments or asset pricing. Now, so corporate finance in practical sense, corporate finance is more relevant to private equity and venture capitalists and consulting, right? You have to advise the CEO how to restructure your company. But what's the NPV if you restructure it, right? So the strategy consultants in McKinsey or Bain or BCG, they should have solid understanding of finance like this. You should be able to tell it in dollar terms. Now, asset pricing is more relevant to the asset management business, mutual fund and hedge fund and family office kind of things. Family office? What is that? Go ahead and Google search family office, right? That's a quasi hedge fund, even smaller one. Only one family invested in it, right? It's just managing their assets. 집사되기, right? So that Bill Hwang and then the family office debacle in March 2021 is a representative case over there. But hedge fund and all these kind of guys are working on these second half of this page, right? Asset pricing or investment. So that's why you feel like, oh yeah, it's all about finance. Isn't it the same thing? But they are somewhat different. Okay, our professors have different majors and different subfields. In my case, I started as a corporate finance guy, and I have some research about market efficiency. And there I talk, those implications in my research has something to do with your quantitative trading ideas over here. That's why I'm teaching it. And then some professors are purely asset pricing guys. All right. And then each subfield splits into neoclassical explanation and behavioral explanation. Neoclassical 2x2 matrix you can think about. 2x2. Corporate finance, neoclassical versus behavioral. Asset pricing, neoclassical versus behavioral. So you see where I am standing, right? Behavioral, both corporate and asset pricing. And then also you can split each subfield into theoretical and empirical studies. If you go into PhD in finance, right, or PhD in economics, or majoring in financial economics, like you still have this split between theoretical and empirical. You may say, oh, isn't everything PhD all about theoretical? And then it's about mathematical. In finance, what you guys learn in undergraduate, it seems like it's all about math. Number. But what we talk about, what we mean by math over here is pure math, which is like mathematics PhD. Okay? Number theory or real analysis kind of things. Those proving theorems, mathematical theorems, right? Those stuff. They are trying to model all these kind of decision behavior, or over here, those microstructure, buy and sell, the games played between the informed traders versus non-informed traders. All these kind of things are mathematically modeled within some formulas in a closed form solution. They try to get this kind of mathematical formulas for each and every behavior. That's theory part. It requires PhD level or master's level of mathematics major, or at least, I mean, that is high level math, right? What you guys been doing in your undergraduate is not even close over here. It's just a child's play. And empirical, here, this is what these data-driven ones, big data or whatever. The job of empirical study is to prove, I mean, not to prove, to test, right? The mathematical guys, the theoretical guys, right? They set up some mathematical formula that models certain behavior, and then empirical guys bring big data in that specific situation, and then those behavioral data, and then test it with regressions or machine learning kind of stuff, and check whether those empirical behaviors in the real world really looks like what these guys predicted in mathematical formula, okay? And see whether their theories are really working or not in the data. That's the split of the split of labor, I guess, between these two different majors. You can think of finance as a 2x2x2 cubic. Quantitative, I mean, 2x2x2 cubic is like this one. And then quantitative finance is more about empirical side of the study. Until now, we've gone through corporate finance. Time to explore the other part, which is asset pricing or invest. Efficient market hypothesis, right? What was that? After vacation, you feel like you're Dory in Finding Nemo. What was that? Hello? Well, it was about the price and value. The price of Tesla, it's observable real time. But true value of Tesla, it's not. Right? It's something that you are, estimating in the dark. And then based on my DCF analysis, it has to be like this or that. Based on your relative valuation, that must be this or that. You will disagree. Everybody will disagree. 100 people will have 101 different opinion about these kind of values, about the same companies, right? Yeah. So observability is a critical difference. If you can observe the true value, then the whole discipline of finance will disappear, right? The bankers will have to go home, right? No need. But true value is not observable, so that's why we make money out of it, right? And then, what are the two channels of value, right? Well, you remember the cash flow, future cash flow, discounted at your relevant cost of capital, right? Yeah. So the relevant cost of capital has to be a function of risk, right? You remember beta, right? Beta, cap and beta, and that kind of things, right? And market risk premium. It's all about risk and return. Risk premium, how would you add it, right? Add it to what? Risk-free rate. Risk-free rate plus beta times market risk premium. That was CAPM, right? Frequently asked question in your job interview anyway. Now, that's your discount rate, which is a function of what? Your risk. Okay, risk is a critical element over there in your valuation, in estimating that value, right? Risk is one element, and the other element is what? Cash flow. Cash flow. Your profitability, operating cash flow, operating income. Why don't you use income, but you focus on your cash flow because of the accounting adjustments that you had to go through? Accounting is accrual based, but finance is more about cash flow based, right? You try to estimate your cash flow, in every year going into the future. Cash flow 1, cash flow 2, cash flow 3, your time point 0, right? 0, 1, 2, 3. 0 and cash flow 1, cash flow 2, cash flow 3. Infinite horizon, you try to estimate those cash flows somehow. Is it observable? No, it's not. It's just you are estimating it using different DCF methods that you come up with, right? And then cash flow is the second or equally great element in your valuation. What was the other important one? The risk, right? So your value is affected by this cash flow and risk. The cash flow and risk are the two channels of value which are affecting those values, right? So that's the second point. When are they the same? Price equals value. When the hell does it happen? Is an interesting question. When it is equal, right? When the price in the market is equal to the true value of your company, that's what we call market efficiency, efficient market. Okay? For that part, those information about what? About cash flow and the risk of the company or the risk in the financial market has to be correctly reflected in your valuation. Not just your valuation, but everybody's valuation, and then it has to be priced like that. Okay, so those information about the cash flow and the risk should be reflected in the price, right? That's what we call market efficiency. Now, EMH in 1960s, economists were putting finishing touches on theory of competitive markets. 완전 경쟁 시장, perfect competition market. Emerging intuition is that in a perfectly competitive market, there is no free lunch. If you remember Economics 101, right? Microeconomics basics. In a perfect competition market, and you are only a price taker, then what is your, what is it? What is your profit out of it? Zero. Your profit, the competitors get into the market until the marginal profit gets into zero. Likewise, your trading in financial market, in a competitive market, there's no free lunch, no money you can make out of it, no profit you can take. You will participate. The market participant will join the market until the marginal gain will be equal to zero. The same idea. Securities market seemed to approximate the theoretical perfectly competitive market. Everything seemed wonderful. EMH definition. This led naturally to the definition of an efficient capital market. An efficient capital market is a market that is efficient in processing information, right? Processing information, thinking, and collecting those information. And the price of securities observed in any time are based on correct evaluations of all information available at that time. In an efficient market, prices fully reflect available information. And the thing is, Eugene Fama, the Nobel laureate, says that he says it like this: a price moves as if it reflects all the information in the market. As if. Does that mean it is really reflecting the information or not? Who knows? Can you really test that? But as if is an important word, right? If it should reflect all the information, the price should move like this and that. And as it turns out, it seems like it is moving that way. So as if it is, price moves as if the information is reflected. Yeah, definition, the hypothesis that the real capital markets actually are efficient by Fama's definition. Yes, here you see Professor Eugene Fama. Hello. EMH definition in mathematics, EMH asserts that price is equal to expected value of P star. P star is a true value. Whatever the economists represent, or notification wise, whatever true things, right? They represent it with star over there. Expected value of true value, or let's say just in brief, true value is the fundamental value. The Warren Buffett says, fundamental value, fundamental approach. It's all about getting the true value. Does Warren Buffett's true value really the true value of that company? Nah, it's just his own eyes. But based on his thoughts, his perspective, and that he to the best of his ability, right? That's what he claims, but there's no guarantee. Again, the true value is not observable. Okay. The present value of all cash flows that investors rationally expect to receive, right? So the true value, how would you estimate the true value? Like this. What the hell? The sigma? Yeah. It's a summation. Summation S-S-U-M. S is a sigma in Greek letter. And then from time period T1 to infinity. And here is a time point, what? T0. Okay? Notice the difference, time point, right? 0. Right now it is time 0. 1 year from now is T1, or 1 day from now. At least it's different from today, okay? Whatever you got in cash today, it's gone, thing is gone. It's gone. What you expect from now, okay? From now to the future, okay? What you expect from in the future. Uncertainty gets in there. The risk gets in there. The cash flow and then the discount rate. In the numerator and denominator, year by year or period by period. And then you raise to the power of t. Raise 1 plus your discount rate to the power of t. Summation of everything, right? ER is the rational discount rate. Yeah, over here. To the extent that all the information is reflected in the price already, it is impossible to predict return. Okay? What do you mean? Price movement. Upward or downward? No. On average, it's going to stay the same. Unpredictable in the sense that it's going to be the same, and then it's just a random walk. Some path, some sample path of realization will be going upward. Some realization may be going downward. Some will be crisscrossing like this. But if you take out of hundreds or thousands of the similar stacks, it's going to stay the same. So that it is not predictable. That's what we mean by it. Unpredictable. Yeah. Already it is impossible to predict return for the future. Price moves like a random walk. Just like a drunken guy's walk. EMH definition. EMH does not say anything about which expected return or cash flow to use. Yeah. Cash flow, I told you. The cash flow is not observable, right? You're just guessing it or estimating it in a scientific wording. And then the discount rate also. Didn't we learn about CAPM? And the thing is, CAPM is only one attempt, one incomplete attempt. Okay? When it's going to be complete, we don't know, right? What is the true discount rate that we should use in valuation? We don't know. We don't freaking know. This is why the finance is fun as well as troublesome. If you're an accountant, a CPA-minded guys, you will hate finance because you want some correct answer. But there's no such thing as correct answer in valuation and then the finance, right? So the accounting professors and finance professors, they argue about this. For the accounting professors, finance is all about, it's sagia, it's like fraud or something. But finance, we are living with that, No correct model for discount rate is there. We are constantly in search of those correct discount rates. That's it. CAPM is just one start. You had a good starting point. Pharma French is coming next. And how does it come? I'll tell you. Week by week, we're going to study that. And that is related to that is really the starting point of the quantitative trading being used in hedge fund. So that's why. Just that what the market uses is right. We are just assuming that what the market uses is right. EMH asserts that P equals the best possible estimate of P star that can be made using a given information set. So as if it reflects all the information. 3 sets of information you can think about, right? Past prices and returns, or past information. Or the second point is all publicly available information. And the third bullet point is about the all public and private information. Yeah, it's like seems like a level going on in terms of timeline, past and present public, and then present private as well. Okay, this leads to three notions of market efficiency: progressively stronger, which is weak form, semi-strong form, and strong form. And weak form says all information in the past price is efficiently included. Semi-strong form is all public information, of course, weak form included, right? Everything should be there in the price. Strong form, all even the private information should be reflected in the price. In other words, weak form market efficiency, past prices and volume information cannot predict future returns. Technical analysis, that means technical analysts, chartists, go home, laid off, fire. Fire joke, no fire. It's a waste of time. Go home if market is weak form efficient. So what does it mean? Well, the technical analysis, right? It's about visual pattern recognition. If you take my behavioral finance class, you must have seen this one. It has to do with your animal instinct about your visual pattern recognition. Whenever you see something, like a screen or whatever, you are driven to identify any patterns within it. And then the recognizing the letters over here is already a pattern recognition, right? But the graph, when you look at the graph, right? Those pattern recognition instinct pops up again. Yeah. And then let's say you are standing here today and then the stock price chart historically has been like this, going up and down and up and down, right? What would happen in your mind? Okay? Well, all of a sudden, you pull out all your memories that you learned in your high school math, like sine function, cosine function, and trigonometric functions, and then functional combination with linear function, all these kind of things, so that you try to justify yourself. Oh, here must be the resistance line, and there must be the support line, so that right now over here we are standing, so that it seems like the next month the price will go up over there based on our technical analysis. So what do? Buy it and then hope and pray that the price will go up there in 1 month. But we sure are the only smart ones in the market like that. But you are not alone. Michael Jackson sang it. And everyone thinks the same way and looking at the same picture just like you. And then if your inference is correct, that the price will go up over there in 1 month, what will happen? People will start to buy just like you at that moment. Buy button, so that what? The price will go up because the demand shoots up like crazy right now. So the price must have gone up to the target price instantaneously right now and start to do random walk from now on over there. The price should have been over here if your inference is correct. But the price is not there. It's still here, which means your inference is wrong. Your technical analysis is useless, right? So that's what, that's the idea against technical analysis argument coming from the EMH guys. Now, how do you test that weak form market efficiency really works? Okay, really works, which means your past price is not informative about your future price or current price, right? The past return is not informative, does not predict return, okay? What do? Well, Eugene Fama's approach is like this. Here, you see R as a return of your stock. I stands for your company, and T stands for your time period. It could be year, commonly year, or months, commonly months, or week or days, or like this, okay? Now, then on your right hand side of your regression, these are the X variable or explanatory variable, and that one on the left hand side is a dependent variable on your y-axis. Your dependent variable is your future return, t plus 1, or 1 time ahead return, and then your explanatory variable is return of time t, or past return, okay? A past return versus future return, like that. Don't ask me current. Current is like future to past. current, this is a current and the past, right? So that's it. It's equivalent as future anyway. Anyway, so you model your regression like this. Empirical model will be like this, and then run a regression, only one variable over here to explain the future return. That's past return, okay? And then if you run a regression, you will have an intercept and then coefficient of your, and then the error terms like this. What matters is this lambda term, right? Lambda. And stock by stock, you do the regression like this. And then test whether this lambda is equal to 0 or not. Your null hypothesis. Null hypothesis is that lambda equals 0, which means your past return has no predictive power about the future returns. So that is weak form market efficiency. On the other hand, if lambda on average is positive, we call it momentum. If it is negative, we call it reversal or overreaction. Okay? So what did he do? He tested it using those US stock data, crisp data, and then found out that the lambda is 0. I mean, he could not reject the null that the lambda equals 0. Okay? More academic way of saying it. Okay? Could not reject the null. You should catch up this academic terminologies to be able to work in this quantitative trading areas, because you will see a lot of masters guys and then PhD guys coming from there. It should naturally come out of your mouth. Anyway, so so he tested it and found out that markets seem to be weak, at least weak form efficient. Semi-strong form efficient. What does that mean? Public information cannot predict the future returns. So the idea going against this is Warren Buffett's idea. Against. Okay, if the market is not semi-strong form efficient, value investors or fundamental investors will think like this, right? Right now, the stock price is over here. The red line is a stock price. And then you're standing over here time 0. And what? You try your DCF analysis of the stock, and then let's say you found out the true value to be this dotted line over here, much above. So what do? Well, buy it right now so that it will, reach this value, the true value that you estimated in the future. Hope and pray that your true estimated value is correct true value. And wait. How long? We don't know. It could be 1 month, it could be 1 week, it could be 1 year, 10 years, we don't know. But usually it's more than 1 year for Warren Buffett kind of guys, and deeply discounted stocks they find, which is called the value stocks, right? Value stocks. And then, so that's the value investment idea. Something undervalued, something different from the true value, which means market is inefficient. Right? And then the idea is like this, but the thing is, you are not alone. Yes, you are not alone. Everybody is smart like you, and everybody thinks the same way, and they get the same public information with you. And if your inference or if your estimation of true value was correct, everybody will be to get the same, almost the same value estimate like this, and they will click the buy button just like you. When? Right now, busily, so that buy, and increases the demand, the price goes up like this, instantaneously, and then the price will go to the random walk from now on. The thing is, right now the price is not here, but there. Okay? That means your valuation framework may be wrong. Okay? The DCF analysis may be wrong. Or the whole value investment strategy or Warren Buffett's idea kind of things is wrong. Okay? That defies it like this. Okay? Now, does the price change instant? So that's efficient market hypothesis, semi-strong form. Now, is there an evidence that market is really semi-strong form efficient? Which means the price moves instantaneously at the release of public information. When the public information is announced, the price responds instantaneously. Here is one case study about Yahoo.com's takeover by Microsoft. It was an attempt. It failed eventually, but it was an attempt. In 2008, Microsoft announced in February that 3rd, right? In the morning, they said they are going to take over Yahoo at $32 or something. And then the price of Yahoo was hovering below 20 or something. Instantaneously on that day, it moved to $30 close, right? 29 or something like this. If you look at the daily stock price chart like this, it's not as much dramatic. But if you look at the microstructure level or intraday level record, right? The price movement was much more drastic like this. This is what I captured in my PhD days. Now it's like this, right? At the morning, in the morning, right? The price already shot up to the target level at the announcement. You could not wait until the evening until the price gets realized like that. Why 28 instead of 32 or something? Because there is a chance that the deal would not go through. So the probability reflected, and then they just respond immediately. It's like gone with the wind, or gone with the bus is gone in Korean terminology. Bus 떠났어 already. So there is only if you invested in Yahoo at that point, and then the next day, shoo, wow. But there is a strict Chinese wall in investment banking world, so you should not release any insider information, right? So that's why the price movement was so silent in Yahoo, like this. And then on the day of the announcement, price movement was this dramatic, all right? That's an evidence of semi-strong form market efficiency. Now, example. How P reacts to news in a semi-strong efficient market, solve for pre and post announcement period, and then example illustrates key principles. In efficient market, P jumps reflects new information about that company. Sorry about this typo or omission. Information about the company or cash flow and risk. Expected cash flows and then discount rates. Moreover, in an efficient market, nothing else besides new information can affect P. So nothing else matters, but the information matter, right? Strong form efficiency, all insider information. The secret is even reflected already, but people have tested it, and then strong form efficiency doesn't seem to work in the reality. Insider information is insider information. It's just kept over there. Even the insider information is reflected in the price. Now, that's the argument, but insider cannot make money. That's the situation if the insider information is already reflected. But many research papers found that insider trading still makes money, which means insider information is not yet reflected in the price. So early research results did not support strong form EMH mostly. And then, can we make money by some trading strategies? Neoclassical economists say, no, there is no free lunch in the market. This bus is gone, or it's gone with the wind. Already gone. Yahoo. I should have bought that one. You will always regret like this, right? What does the rational or the neoclassical economists say? Well, just be a passive investor in that you buy and hold index fund, KOSPI index or S&P 500 index, so that you just follow the average, right? So that's the best strategy for if you subscribe to that neoclassical economist idea. Yeah, active fund management does not give you any money, any alpha, okay? And it's very depressing emotionally. Oh my God, I cannot make money like that. I'm so inferior. Well, that's the reality. The market participants are very, very smart and very, very fast already. Yeah. Neoclassical finance versus behavioral finance. The one question is, are prices completely rational? Is the financial market completely efficient? Neoclassical finance guys say yes, 100% rational and efficient. These guys are coming from Chicago, Minnesota, Carnegie Mellon. So we call it Chicago, Minnesota, Carnegie Mellon School of Thoughts, or 담수학파 in Korean terminology, because these schools are surrounding or around, okay, those Great Lakes, 오대호, around, right? And then behavioral finance guys say, no, in some cases prices can deviate from fundamental value and become mispriced. Prices can do this because investors make mistakes which are not always corrected by other traders. And these guys come from the rest of the places.